because as we saw in the turbulence and problems we've had in the last 3 or 4 years, a lot of people have leveraged their residential property, which is where we keep mum and the kids, or dad and the kids, because I don't want to be sexist, safe, and we're risking it all with the business, and maybe the bank will take it back, and I have seen that happen. So the situation, if you can look at securing any funding you do over the project that you're doing or using assets you have within the business to secure it, that's the first rule, because that security issue is the one that can come back and bite you on the bum. The second one is you need flexible things. Now, the new fintechs provide things like unsecured overdrafts. They do them up to $250,000. So you can actually get an unsecured overdraft. Now, admittedly, their rates are not like the bank. The bank's going to charge you between 12 and 15. They're going to charge you more like 19 and 20, but they're not going to take a mortgage over your property. They're going to secure it just on your signature and on your cash flow, because the way modern lending goes, the banks have traditionally always done this, but the new fintechs, and this is whether it's debtor, trade, or an unsecured overdraft, they look at your cash flow by taking a link to your bank. So quite easily, they put in a system where they can have read-only access to your bank account, standard on all credit applications these days. And no matter what the financials tell, the real story is what we see in the bank balance. They see all the good and all the bad. So I've had clients that were looking good, have great credit ratings, but a current check on their bank shows that they've had 6 missed payments in the last 2 or 3 months. And it's not quite like bouncing checks. It was just like insufficient funds. That basically destroys their credit application. So you've got to realize your conduct within your bank account is one of the most important things you need to keep an eye on.